Hi, this is Michael King, and today we're going to talk about Robo-Advisors and digital wealth management. Robo-Advisors merged around 2008, and they're automated online platforms that allow an individual to make an investment easily, quickly, and less costly by leveraging technologies such as computer algorithms and artificial intelligence. They're directed at individual investors. They've really come into their own by offering sophisticated portfolio tools at a low cost with fees of 25 to 50 basis points of assets under management. A robo-advisor initially was an automated end-to-end investment process, although recently robo-advisors have started offering the ability to speak to a human advisor, whether a salesperson or a registered financial advisor, for a higher fee. They've also been expanding into financial planning, personal finance, and even banking. The first robo-advisor was US-based Betterment, founded in 2007 and launched in 2010. Betterment was followed by others such as Wealthfront, Personal Capital, and Future Advisor in the United States, and it spread quickly to other countries such as Canada, Australia, and Europe, where these robo-advisors were really following a disruptive innovation strategy taken from Harvard professor Clayton Christensen's playbook. They were targeting this underserved customer segment of millennials who did not want to interact with a traditional investment advisor and were willing to pay in order to transact online. They also succeeded in attracting price-sensitive, older, more mass affluent investors who were unwilling to pay the high fees typically associated with wealth management of 2% or more of assets under management. As you can see, there are wealth managers all around the world, with CB Insights tracking their growth from 2013 to 2017 and counting at least 65 robo-advisors. By 2018, the largest robo-advisors judged by assets under management were incumbents such as Vanguard, Schwab, and Fidelity. These robo-advisors were launched in a second wave starting around 2013. Although they may offer higher fees or require higher account minimums, they've been very successful in attracting clients. What are the benefits of a traditional robo-advisor? Robo-advisors compete on the basis of their delightful customer experience, their transparency and low fees, and their state-of-the-art technology. They're fast, easy to use, enjoyable, they have beautiful design, they're available 24/7. Onboarding is quick, as well as investment recommendations, and they spend a lot of time on education as well as other frequently asked questions. Unlike the traditional wealth management industry, where many of the fees are large and hidden, robo-advisors have focused on being entirely transparent. There's typically a low or no minimum investment, there's no fee for some initial amount, and then a low fee of 0.25% of assets under management, or even a $2 per month fee as seen with Acorn. Premium services such as tax loss harvesting or smart beta strategies will cost slightly more, up to 0.5%. Because they're not burdened by legacy IT systems, robo-advisors have been able to build from the ground up using the best technologies. They have clean, easy to follow dashboards, and they're able to get real-time analytics to their customers. So robo-advisors were initially seen as disrupting wealth management. However, incumbents have been very fast followers. Providing code and putting a service online is not a sustainable competitive advantage. Vanguard was the first incumbent to respond in mid-2013 with personal advisor services. It required a minimum investment of $50,000, a slightly higher fee of 30 basis points for up to $5 million of assets under management, with a lower fee for higher balances. But they made up some of this low fee by selling in-house mutual funds and ETFs, where they could capture the fees for management expense ratios for those funds and ETFs. Within 6 months, Vanguard had matched the robo-advisor leader, Wealthfront, and by end of 2018, Vanguard had captured 56% of all assets under management for robo-advisors, or $112 billion. Other incumbents that quickly launched robo-advisors are Charles Schwab, Bank of America Merrill Lynch, Capital One, E-Trade, Fidelity, and TD Ameritrade. And many of these robo-advisors have subsequently moved to no-fee trading in order to compete with fintechs backed by VCs who simply cannot match this high cost of customer acquisition. Here you can see from CB Insights the incumbents who have launched the RoboAdvisors and others who have chosen to partner and white label the services of RoboAdvisors such as SigFig or Next Capital, with many others under development. RoboAdvisors are simply one part of what we call digital wealth management. Wealth management itself is a series of activities from financial planning to investing to back office. Globally, wealth management has 70 trillion of assets under management, so it is a massive industry. Financial planning is basically setting goals and making a plan to achieve them over an individual's lifetime, where our needs change as we grow. Early on in our careers, we're saving for a home, possibly for a child's education. We accumulate debts, and later we start to accumulate assets, allowing us to plan for retirement. You typically work with a registered investment advisor or a financial advisor in many face-to-face meetings, which costs time and money and leads many people to prefer to do it themselves rather than waste time with the pain points of speaking to an advisor and being charged for it. Digital wealth management is all about leveraging technology to provide a better customer experience at a lower cost with faster, more convenient online platforms. Digital also allows robo-advisors as well as investment advisors to provide a more personalized service to customers faster and cheaper using technology. So digital wealth management really has targeted the high fees and the many customer pain points in the wealth management value chain. This wealth management value chain has three parts: asset acquisition, portfolio management, and operations, where the key tasks are shown here. Each of these key tasks can be broken down into subtasks as shown in this figure. As you can see under marketing, there's customer acquisition as well as distribution through third-party sales. When it comes to customer onboarding, it's collecting data and complying with Know Your Customer regulations. Portfolio management itself has four parts: profiling your customers, knowing their risk and return objectives, knowing their level of knowledge, how much they have in terms of assets. Moving on to the asset allocation, which involves research on the forecasts for returns and volatility for different asset classes, the correlations, and the other inputs to the mean variance process. Actually constructing the portfolio involves buying and selling of securities as well as settlement. Ongoing, the rebalancing and optimization of these securities to reflect movements in weights due to asset price changes, and implementing strategies such as tax loss harvesting or factor strategies such as smart beta. Behind the scenes, in the back office, we have reporting and administration involving filing reports on performance, taxes, as well as fees, and providing other real-time analytics to customers, completing custody, proxy voting, securing data, and meeting compliance requirements. Fintechs have attacked each of these individually or combinations of them where the profit pools are largest. Many people wonder whether human financial advisors are ultimately going to be replaced by computers. The answer is no. In the future, digital wealth management is going to be a human advisor supported by a computer algorithm that will provide customers with a better experience at a lower cost. Fidelity conducted research of its own investment advisors, comparing traditional advisors that did not technology with those that leveraged technology, including social media. These e-advisors, as they called them, were able to serve 55% more clients and managed 40% higher assets under management, making them much more profitable and allowing a smaller number of advisors to manage a larger number of clients. Increased productivity is particularly important given that many investment advisors are reaching retirement age and are unable to find anyone to take over their practices, as there are fewer and fewer individuals going into the financial advisor business. We find also that some customers still want to speak to a person at some point in the investment process, whether to get more advice, to make their financial plan, to calm their nerves during market turmoil. Betterment, the pioneer in the robo-advisor space, began offering customers the opportunity to speak with a human advisor as early as 2017 for a premium fee of 40 basis points. Other robos have since copied this strategy, with only a few holdouts that are still fully automated. The key takeaway is that digital wealth management is about leveraging technology to improve the customer experience at a lower cost. While RoboAdvisors have been the most visible fintechs working in this space, they have faced an uphill battle fighting incumbents, particularly to acquire customers. As a result, incumbents have been able to capture and pass the fintechs, many of whom have subsequently pivoted and started partnering with incumbents, offering to license their software and through white labeling, or to provide other business-to-business businesses such as real-time analytics, customer onboarding, and other back-office tasks. The future of wealth management is going to be a human paired with computer algorithms that will increase their productivity by automating routine tasks and providing more timely, personalized customer support. Thank you, and you can find more in the chapter written about RoboAdvisors and digital wealth management.